There's so much data that's out there that if you don't have good tools that are different than most of the rest of the market, then you're really behind and going to struggle giving yourself an edge. I think it just the people that are on the old software with drop down windows and all the technical tools. I mean, you have to have something that separates yourself from most of the rest of the market and then be able to understand why this tool or that tool would actually work. You got to know why you get to four from two plus two instead of just memorizing it. And it's got to be intuitive. So what you're looking at is the recording of today's session. And we went red to green pretty quick right in here, but that was pretty much just one big position open. Now let me rewind it. I might have started the recording after the, no, good. So I started it. Watch what happens here. Our laser is red, which means there's more shorts than longs. And then something changes. Well, a big long came in and it's gonna wash out this vertical here. Boom. See him? It's probably about 250 contracts. See, it's 301 down in here. Most of it's this guy, and he's trying to get out up there. Now, this is a real position with a real exit order. And you could see this white exit order could move around. Where he's long from won't move around. But this one can, as you could see, he's lowering it. And you don't want to be just one guy like this isn't necessarily that bearish to get short, but it did break. You'd prefer, if you were long, this not to happen, a big long coming in, because this order and maybe many others could compete with you if you're long. But either way, it went red to green, and we started selling off a little bit. This pink laser, I'm sorry, this pink triangle shows you a sell imbalance. But let's just roll through this, and I want you to see when it goes away, it's generally there, it goes away, but it's still here on this vertical, which means the only reason why it went away is because 2 minutes expired. This vertical here will just keep a rolling 2 minutes. So it goes away if the order is filled, the guy's exit order. He cancels it. We have to assume he's filled, so we'll pull it. Or 2 minutes expire, in which case it'll go to this vertical for the next 59 minutes. This is an hourly OPP. You could see he's right there with his exit order right there. But you see the laser, the green line, shrunk quite a bit. Now, let's just let it roll. You could see the amount of longs that were pouring in. It stayed green. It went down. Look at this. It doesn't go up until it gets red. Boom, it gets red. It rallies. And you could see the shorts coming in. The white lines in here are exit orders of the position. And that's why red typically be bullish, because a short, now the position has to come to the market as a buyer to cover that position. And so just kind of keep it simple, but that was kind of an interesting big order that came in pretty quickly after the open. Another thing is, you're not going to see it on this particular chart as well as a candlestick, but the congestion box was forming. And I had said you got to be careful being long. I'm sorry, be careful being short above, what was it, 30.31? And there we go. One of the reasons was the market, when you want to talk about chart patterns, you don't have to get carried away with chart patterns, except for congestion boxes. So I'm going to make this look like you might see in a book, but this would be a congestion box. The highs up here, the lows down in here. It's not going to look that neat and pretty in you know, in real life. But for example's sake, you got to be careful after multiple attempts to the high. And I said this in real time when I was saying little Johnny, the fifth grader who trades his mommy's money, he sees good resistance. That's when he determines it's going to be good resistance, only because it's already been good resistance. So if it's obvious to a fifth grader, it's probably not going to be consistent or something you want to use a lot. All right. And then you get this breakout. Markets rally and break out of a congestion box because at some point inside this box, you've accumulated too many short positions. When I say too many shorts, I mean many more shorts than longs. It's the imbalance of positions that create direction. You need an imbalance of positions, which give you an imbalance of orders. And it's those imbalance orders that make the price of anything go up or down. Everybody's just looking for buyers and sellers, buyers and sellers. But where do buyers and sellers come from? Well, they come from people already in a position. Now, I understand a buy order could be an order to open a long. Of course, you got to open it sometime also. But when we can create a sample size of how many people are using a buy order to get long, all of a sudden we could compare it to those that are short and create an example of too many longs, too many shorts. And so in the step-by-step process of trying to predict where buyers and sellers are going to come in, you first would like to know other people's positions, or OPP. You get a handle on other people's positions, and then you could compare them to each other, longs and shorts in this case. You can then predict whether or not there's going to be imbalance of buy orders or sell orders. Buying and selling. If you don't know why price moves, you have no business predicting it.